Right now, 20% of the global oil trade is essentially just trapped.
Mm.
I mean, tankers are turning around in the middle of the ocean, pipelines are running dry, and European factories are staring down this energy crisis that honestly makes the last one look like a dress rehearsal.
Yeah, it's really staggering when you look at the sheer scale of it.
But the crazy part, right, if you look over at Wall Street, some of the absolute largest retirement and pension funds in the world are looking at this exact same geopolitical chaos, and they're actually, well, they're cheering. And today, we are finding out why.
It's April 2026, and the closure of the Strait of Hormuz has essentially, pulled the bottom block out of the global supply chain. We are looking at 10% of total global oil production physically shut in,
Right.
literally overnight.
10% just gone.
Exactly. And you're right, the way this massive shock travels through the system, destroying certain sectors while miraculously rescuing the balance sheets of others, it's completely counterintuitive. Well, if you don't know where to look anyway.
Which is exactly the mission for this deep dive. Because, for you listening, we really want to unpack how this specific choke point is sending shockwaves everywhere. We've got this great stack of sources we're pulling from today. The latest economic bulletins from the European Central Bank, some rapid response reports from the IMF, and these incredibly revealing market pulse memos from portfolio strategists at places like Goldman Sachs and LSEG.
Right. The LSEG notes are particularly fascinating on the market sentiment side.
Yeah, they really are. And we're using all of this to map the tremor. It's kind of like a massive game of Jenga. You pull out one critical piece, like the Strait of Hormuz, and the wobble doesn't just stay in the Middle East. It travels all the way up to European gas storage and eventually straight into U.S. Treasury yields.
I think the best place to start tracing that line is Europe, because they are sitting at ground zero of this secondary shockwave. The timing of this Strait of Hormuz closure is uniquely devastating for the euro area, honestly.
Because of the winter they just had, right?
Exactly. Qatari liquefied natural gas, or LNG, shipments have been entirely suspended because of the conflict. And this suspension hit the market right on the heels of that notoriously harsh 2025-2026 winter.
Right, because they had to burn through basically whatever reserves they had just to keep the heat on. The ECB bulletins actually note that European gas storage was sitting at a critically low 30% capacity when this whole conflict broke out. 30%.
It's a terrifyingly thin buffer, and the market reaction was violent. I mean, the Dutch TTF gas benchmark, which is the main pricing reference in Europe, it nearly doubled.
Yeah, it shot past 60 euros per megawatt hour by mid-March, didn't it?
It did, and at the exact same time, global oil spiked from around $70 a barrel to well over $115.
Over 115. That's just a brutal dual shock.
It is. And the ECB actually mapped out what this means for the real economy on the ground using two different projections. So their baseline scenario, right, it assumes this is a relatively short conflict.
Which feels a bit optimistic, but okay.
Very optimistic. But even under that assumption, euro area growth drops to a highly anemic 0.9% for 2026, and inflation rises back up to 2.6%.
Okay, so that's the best case scenario. What's the alternative?
Well, the severe scenario is what's keeping policymakers awake at night. If this disruption drags on into 2027, the ECB is warning of outright stagflation. We're looking at inflation pushing past 6%, economic growth grinding to a dead halt, and major energy-dependent manufacturing hubs, places like Germany and Italy, just being pushed into a technical recession.
Okay, let me push back on this a little bit, though.
Yeah.
Because I'm looking at the notes on Europe's response to the 2022 energy shock with Russia. And they pivoted incredibly fast back then. I mean, they subsidized the pain, they built new terminals, they bought up American and Middle Eastern LNG. Why can't they just, run that exact same playbook again? Why are they caught completely flat-footed this time?
That's a totally fair question. But the fundamental arithmetic of the global energy market has changed. You can really only pivot so many times before you just run out of alternative.
Right.
In 2022, the Middle East was the alternative they pivoted to. Now, the Middle East is the source of the shock. Furthermore, U.S. LNG export capacity is largely maxed out right now. They cannot magically conjure up the missing 20% of the global supply overnight.
So the safety net is just gone?
Basically, yeah. But the deeper issue here is cumulative pain. Economists in these reports are heavily warning about permanent deindustrialization. European chemical and steel manufacturers are already slapping 30% surcharges on their products right now just to cover surging electricity and feedstock costs.
Wow, a 30% price hike on base materials like steel and chemicals. That isn't just a minor inconvenience. I mean, that completely destroys your global competitiveness.
Exactly.
If you are a German manufacturer, your clients in Asia or the Americas aren't going to pay 30% more for your steel when they can just buy it locally.
And once those clients leave, they rarely come back. That's the terrifying part. If it costs 30% more to run a factory in the euro area than it does in the US, those companies don't just temporarily pause production. Eventually, they close the factory, they lay off the workers, and they relocate the capital entirely.
Yeah, they just leave.
Right. So the structural damage to Europe's long-term economic stability is no longer theoretical. We are watching the early stages of actual capital flight.
But, reading through the sources, it seems like Europe isn't just sitting there waiting for the lights to go out. They're trying to deploy some massive structural shock absorbers to mitigate these growth risks.
They are, yeah. It's not all doom and gloom.
Like Germany, despite its manufacturing woes, is pouring massive amounts of public funds into infrastructure and defense spending. It feels like a brute force way to keep domestic demand from collapsing. You build bridges and military tech to keep people employed even if the steel mills are struggling.
That's the traditional Keynesian shock absorber for sure. But the IMF and ECB reports highlight something much more interesting to me. It's digital investment. Specifically, the rapid adoption of artificial intelligence by euro area firms.
Yeah, the AI component is fascinating here.
Yeah.
But I want to make sure I understand the mechanics of that, because AI servers obviously require a massive amount of electricity. So how does adopting an energy-hungry technology help mitigate an energy shortage?
It seems backwards, right?
Totally backwards.
But it comes down to aggregate efficiency. When energy input costs spike, a company's profit margin is instantly compressed. You cannot control the price of oil.
Right.
But if you integrate AI into your logistics networks, your supply chain management, your administrative overhead, you can drive massive, rapid productivity gains. You streamline your operations to such a degree that you are doing significantly more output with less labor and less material waste.
Okay, so give me an example of how that offsets the energy use.
Sure. Let's say a shipping company uses AI to optimize its entire routing and loading process across Europe. The electricity used by the AI data center is basically a drop in the bucket compared to the millions of gallons of diesel fuel the company saves by never driving an empty truck or taking an inefficient route.
Oh, wow. Okay, that makes sense.
Yeah, the IMF explicitly notes that this kind of technological integration effectively relaxes supply-side constraints. It acts as a counterbalance to the energy drain by wringing every possible drop of efficiency out of the system.
So if I'm hearing you right, it's kind of like outfitting your house with state-of-the-art solar panels, smart thermostats, and hyper-efficient appliances, while the neighborhood power grid is actively catching fire.
That is a perfect analogy, yes.
Like, it might not fix the burning grid, but it stretches whatever power you do have to keep your lights on and your fridge running.
Exactly. Structural investments and AI efficiency are the solar panels shielding the house. But the neighborhood grid is still on fire. And the people responsible for fighting that fire are the central banks. And right now, they are dealing with sheer panic.
You see that panic clearly in the market volatility indices, right? I mean, the VIX, which is essentially the global market's fear gauge, it surged by 11.7% almost instantly. And you can track that fear directly back to the skyrocketing costs of shipping insurance and that spike in oil we talked about.
Yeah, it's a direct line.
Which puts the European Central Bank and the U.S. Federal Reserve in this brutal no-win dilemma. The ECB actually had to completely scrap the interest rate cuts they had heavily telegraphed for March 19th.
They have no choice.
And the Fed is holding rates steady, with their median long-term target resting around 3.125%.
Right, because they are trapped between two collapsing walls. On one side, economic growth is visibly tanking because energy costs are choking businesses. But on the other side, inflation is surging again because of those exact same energy costs.
See, here's where it gets really interesting for the average person. If you're listening to this and looking at your own mortgage rates or business loans, it seems completely backward. If the economy is slowing down and teetering on a recession, shouldn't central banks be rushing to cut rates to save us? Why are they just sitting on their hands, keeping borrowing costs painfully high?
Because they are absolutely terrified of a wage price spiral, compounded by what the IMF calls a flatter supply curve.
Okay, break that down for us.
To understand why they're holding rates high, we have to look at the mechanism of modern inflation. Central banks cannot print more oil. They cannot deploy an aircraft carrier to reopen the Strait of Hormuz.
Right.
The only tool they have is a hammer that destroys demand. If energy prices make everything more expensive, workers naturally demand higher wages just to survive. If companies pay those higher wages, they protect their margins by raising prices again.
And there's the spiral.
Exactly, that is the spiral. And once the public expects inflation to stay high, that psychology gets anchored, and it is incredibly difficult to break.
And what exactly does a flatter supply curve have to do with this? We see that term popping up in these economic bulletins all over the place, but what is the actual mechanism there?
Yeah, it's a bit wonky, but a flat supply curve essentially means that global supply chains are brittle and maxed out. In the past, if demand went up, factories could just easily ramp up production to meet it, keeping prices relatively stable.
Because they had the spare capacity.
Right. But today, because of geopolitical fracturing and capped energy resources, businesses cannot easily produce more goods. So if central banks cut interest rates and stimulate demand right now, businesses can't make more products. They will just instantly raise the prices on the limited products they do have.
Oh, man. So cutting rates would just immediately ignite inflation without actually creating any real economic growth.
Precisely. In plain English, this means trying to squeeze inflation out of the economy today requires a much harsher, more painful approach than it did even in 2022. They have to keep borrowing costs punishingly high to actively choke off demand, because the alternative runaway inflation is viewed as structurally fatal to the economy.
So they are actively choosing the slow, grinding pain of a stagnant economy over the fast, chaotic destruction of hyperinflation.
That's the reality of it, yeah.
And if we want to know if that strategy is actually working, the sources point us to the bond market. Because the bond market is essentially grading the central bank's homework in real time.
Yes. And to read that grade, we really need to look at sovereign yield curves, specifically U.S. Treasuries, which, set the tone for global finance.
Okay, let's decode that for a second. Right now, the 10-year U.S. Treasury yield sits at 4.25%. While the 2-year Treasury is at 3.75%. So let's translate what those two numbers actually represent. The yield curve is essentially a tug of war. The 2-year yield is heavily influenced by central bank policy. It represents the Federal Reserve pulling the rope, keeping short-term borrowing costs high to choke off inflation.
Right.
Meanwhile, the 10-year yield represents the broader market's expectation of long-term economic growth and inflation. So right now, the difference between the 10-year and the 2-year is positive 0.49%, or 49 basis points.
And context is absolutely everything for that spread. Historically, that spread averages around 0.85%, so the curve has flattened significantly.
But wait, usually when financial media talks about yield curves and recessions, everyone screams about an inverted yield curve. That happens when the 2-year pays more than the 10-year, meaning the short-term chokehold is stronger than the long-term growth expectation.
Yeah, that inversion is the classic blaring alarm for an imminent recession.
Right, but we aren't inverted right now. We're just unusually flat.
Which tells a much more nuanced and perhaps more frustrating story. An inverted curve screams that a sudden crash is coming. A flat curve, like we have now, signals chronic, anemic growth.
Ah, so it's a different kind of warning.
Exactly. Investors are looking at the geopolitical reality and pricing in a slow, grinding stagnation. They know central banks will eventually be forced to cut rates to prevent a total collapse, but they also know inflation is too sticky to allow for deep, rapid cuts. It is a total stalemate.
And over in the euro area, the reports show a different kind of stress, right?
Yeah, long-term yields have moved higher across the board over there, but the spreads between individual countries have widened sharply due to geopolitical risk. Investors are fleeing riskier European sovereign debt and parking their money in Germany, which is kind of ironic because Germany is benefiting from those safe haven flows despite its own industrial struggles.
Wow. So if the inverted yield curve is the global economy's engine completely seizing up, this flat yield curve is more like the engine sputtering on bad fuel. You are pressing the gas pedal, but you aren't accelerating. The car isn't dead yet, but you are definitely losing horsepower.
It's a slow drain of momentum. And this brings us to what I think is the most fascinating dynamic in our sources today: how the professionals, the people driving the biggest portfolios in the world, are steering their money in response to this sputtering engine.
Well, let's follow the money then. Because professional portfolio managers are navigating this environment very differently than retail investors. If central banks are purposely choking the economy and growth is tanking, you would logically assume that institutional investors would be panicking.
I think so, yeah.
But the data shows some of the largest players are actually taking a victory lap.
It is one of the greatest ironies of global finance right now. We have to look at massive institutional players. Specifically defined benefit, or DB, pension funds.
These are the funds managing trillions of dollars for retirees.
Right. And you would think high interest rates and geopolitical panic would absolutely devastate them. But mathematically, higher interest rates dramatically improve their funding position.
Okay, let me make sure I have this straight. Let's break down the math on why that happens, because it's the ultimate aha moment when you grasp it. It all comes down to the concept of the present value of future liabilities, right?
That's the exact phrase, yeah. Simply put, a pension fund's entire existence is based on future liabilities. They owe money to retirees 20 or 30 years from now.
Okay.
Let's say a fund knows it needs $100 10 years from now to pay a pensioner. If interest rates are practically zero, like they were a few years ago, the fund has to hold almost the full $100 in cash today to ensure they can pay that debt.
Because it's not earning any interest in the meantime.
Exactly. But if interest rates are at 5%, they only need to hold, say, $60 today, because the interest will organically grow that 60 into 100 over the next decade.
So high interest rates just magically erase huge chunks of their required funding overnight.
It really is like magic for their balance sheets. Because of this math quirk, they suddenly look fantastic. They are sitting on a massive surplus.
So what are they doing with this windfall? Are they investing in the market?
No, they are rushing to de-risk. They are taking their chips off the table. Pension funds are using this mathematical surplus to aggressively buy up safe, long-dated government bonds. They are locking in these high yields for the next 20 years to perfectly match their future liabilities. They have essentially won the game, and now they are cashing out into safety.
But wait, here is the massive vulnerability in that setup. If the central banks have stepped back from their pandemic-era bond-buying programs, and these massive stabilizing pension funds are taking their money and hiding in government debt, who is left to buy the risky stuff? Who is funding the corporations?
That is exactly the market fragility that the LSEG and OECD reports are warning about. Because the institutional giants have retreated to safety, the riskier corporate debt, the high-yield bonds that businesses desperately need to survive this energy shock, is left to be absorbed by price-sensitive hedge funds and retail investors.
And those investors aren't running a charity. If a hedge fund is going to lend money to a chemical company that is currently paying double for its energy, they're going to demand a massive premium for taking on that default risk.
And we see that clearly in the data. High-yield corporate credit spreads are widening rapidly. Professional managers are demanding to be compensated handsomely for the rising default risks associated with the energy shock.
So the entire market structure has lost its traditional institutional shock absorbers. The so-called smart money is safely locked in government vaults, while retail money and aggressive funds are left exposed to the extreme volatility of a global economy trying to reprice energy in real time.
It is a masterclass in the absolute interconnectedness of modern finance. Geopolitics dictates energy. Energy dictates inflation. Inflation handcuffs monetary policy. And handcuffed monetary policy fundamentally rewrites the rules of investment risk and capital allocation.
They're all connected.
Completely. None of these systems operate in a vacuum. They're all reacting to the exact same stressor.
You know, when you pull all these threads together, you really start to see the entire machinery of the global economy laid bare. We start with one action, the closure of the Strait of Hormuz. And from there, the dominoes fall in a perfectly logical yet terrifying sequence.
Yep.
A closed waterway in the Middle East immediately empties gas tanks in Europe. The resulting energy spike terrifies central banks into keeping borrowing costs high to prevent a wage price spiral. Those high interest rates flatten the Treasury yield curve, signaling a long, slow economic grind. And that exact same high-rate environment mathematically rescues the balance sheets of massive pension funds, prompting them to hoard safe government bonds and leave the rest of the corporate market exposed to a brutal credit crunch.
It changes the way you look at the news entirely. You stop seeing isolated events and start seeing the ripple effects.
It really does. And it leaves me with one final thought, something for you listening to mull over long after you finish this deep dive today. For the last 30 years, we have built a globalized, just-in-time economy. It's this incredibly intricate system where efficiency and cheap capital were prized above absolutely everything else.
He basically traded resilience for margin.
Exactly.
Yeah.
But if a single geopolitical choke point can instantly derail global growth, spark the threat of permanent deindustrialization in Europe, and fundamentally rewrite bond markets overnight,
Right.
are we witnessing the permanent death of the just-in-time era? And if geopolitical shocks are no longer rare black swan events, but just the accepted new normal, will you have to permanently rethink what a safe investment actually is when the foundation of the global economy is constantly shifting? It's a lot to consider. Thank you so much for joining us on this deep dive. We'll catch you next time.